Well, I think we'll see a continuation. I mean, that downbeat view of growth is actually, ironically, what's driving the better tone. So we've got a sense that actually financial conditions are starting to ease off. Look at the 10-year Treasury yield, we're down sort of below 2.7% now. The equity market is up. And while discount rates might still be firm, and I think you quoted Neil Kashkari saying the Fed is hell-bent on coming back to 2% inflation, that's going to imply more on the discount rate side. The reality is people see recession coming around the corner, and I think that trend is going to stay in place into August. I mean, some of the news flow in July was actually pretty shocking. One thing that caught my attention was volume of shampoo and diapers sold in the US has actually fallen. So people are compromising on basic hygiene in order to try and make savings. So I think even though a lot of the data isn't universally saying recession right now, I think it's in the wings now, and I think we're going to see more of this develop in August. So we'll probably see, lots of flights, clearly very busy in the airports, and then suddenly I think things will slow down. So as the suntans fade, I think we've got a very, very tough late August and September awaiting us. The consumer's already showing signs of slowdown. And I think that is what's feeding the sort of easier financial conditions on these longer term metrics, for example, 10-year Treasury and longer term interest rates.
Well, do you think there's safety in the Treasury curve at the moment? If you don't want to wait around for that suntan to fade and equity market conditions to weaken, as you point out, the risk premium is rising in equity markets. Does the Treasury market represent a safe haven at this point, or should we still be concerned that the Fed actually isn't really done?
Well, I think that the two are different. I mean, I think what the Fed is doing is now becoming different to what the market is thinking is the result of what the Fed does. So actually, for the first time, I think this year, the Treasury market has started to respond more to the prospect of recession rather than to the prospect of inflation. So inflation, I think, is already in the news. We see it. We've seen it over the last few months. But base effects are probably going to catch up, and now we've actually got to deal with the impact of the Fed's response to that, and that is going to cause a recession and a slowdown in growth, and that's what's being priced in that long-term Treasury market. So actually, the 60-40, after 6 months of not really working very well, may in fact start to work well as it does what it's supposed to do, and that is perform better in low growth conditions and in recessionary conditions. So yeah, I would think it's still a valid part of portfolio construction.
Julian, I know that we always say that past performance is not a reliable indicator of future performance, but history can be a guide nonetheless, can't it, Julian? And just taking a look at the way the market has reacted to when in the past, going all the way back to the 1980s, when the Fed has finished its rate hiking cycle, sometimes it takes up to 2 years or more for the market to actually find its real bottom. Is it possible that it might behave in a similar way this time, or because of COVID and the war in Ukraine and all kinds of other variable factors, this time is different?
Well, I think it's a matter of what's new news, and right now the new news is that we've got a recessionary picture starting to emerge, and I think the market has leapt from that to actually eventually the Fed will need to ease, which I think is actually a fair conclusion. If you look at the euro-dollar futures between 2022 and 23, it's showing a 75 basis point cut. And I don't think that's unreasonable. I think the reality is that the Fed, if it had been serious about inflation, like really properly serious about inflation, I think we would have had a much more aggressive pathway. I think actually what's going on is that they are praying that the data will slow down and that they will actually have an out. And I think they will get that out in the coming months. I think it's going to get pretty ugly. There'll come a point where they can't keep tightening things up because the consumer will be on its knees. And of course, the consumer on its knees is a welfare issue, and central banks are much more attuned to human welfare than they were, say, 40, 50 years ago. So I think the Fed will sort of back off pretty quickly over the next few months, and that is going to give, again, that's going to help the market. Although the market, I think, is more concerned with what's going on with the long-term financial condition metrics, and it's taking encouragement from that. And markets, of course, react to changes in the news, and we're moving from inflation to recession and what happens beyond that, which in my mind is secular stagnation. And that's a world in which markets can thrive, particularly long duration equity technology stocks can thrive in a world where growth is low and interest rates are low. And I think we're heading back to that world. That's that sort of old pain that we're used to, that we've had over the last 20 years.